The Venezuela trap was meant to enrich the U.S. by seizing free oil, but the cost of that free oil was the trust of the only nation that keeps the dollar alive. The U.S. gained 50 million barrels of crude, but they lost the Saudis. To understand the magnitude of what is happening in the global bond markets this weekend, you cannot just look at the ticker tape. You have to go back to the source of the American empire's true power. It isn't the military. It isn't the Marines. It isn't even the nuclear arsenal. It is a secret agreement signed in a smoke-filled room in 1974. 50 years ago, during the height of the oil crisis, Secretary of State Henry Kissinger flew to Riyadh on a desperate mission. The U.S. economy was crumbling, inflation was skyrocketing, and the dollar was losing value. Kissinger made a deal with the House of Saud that would define the global economy for the next half-century. The terms were simple but revolutionary. The United States would provide absolute military protection and advanced weapons to the Saudi kingdom. We guaranteed their survival against all enemies. In exchange, Saudi Arabia agreed to do two things. First, they would price every single barrel of oil sold to the world exclusively in US dollars. Second, and more importantly, they would take those massive dollar profits and recycle them back into the United States by buying US Treasury bonds. This system, known as petrodollar recycling, is the engine that allowed the United States to run massive deficits for decades without going bankrupt. We could print endless money to fund our wars and our welfare state, and the Saudis would always be there to soak up the inflation by buying our debt. It was the perfect infinite money glitch. But today, at 4:01 a.m. Riyadh time, that machine didn't just stop, it was smashed. The seizure of Venezuelan assets this week was the signal that the protection part of the deal is void. If the U.S. government is now in the business of seizing sovereign assets instead of protecting them, the Saudis have absolutely no incentive to keep holding up their end of the bargain. This brings us to the Sandman Protocol. In financial intelligence circles, Project Sandman has long been rumored as the doomsday option, a coordinated effort by major non-Western nations to simultaneously dump the U.S. dollar to break its dominance. For years, mainstream economists dismissed this as a conspiracy theory. They said the Saudis would never do it because it would hurt their own investments. But looking at the bond yield charts this morning, it appears the operation has gone live. We are witnessing a silent liquidation. Saudi Arabia isn't holding a press conference to announce they are selling. That would be amateur hour. If they announced it, the price would crash before they could get out. Instead, they are executing a strategic, high-volume sell-off of U.S. treasuries behind the scenes, using dark pools and non-reporting intermediaries in London and Singapore. The mechanism they are using is devastatingly simple, and it targets the U.S. Treasury at its weakest point: the rollover. Saudi Arabia holds a significant portion of its wealth in short-term U.S. Treasury bills, T-bills, that mature every 30 to 90 days. Normally, when these bonds mature, the Saudis take the cash and immediately roll it over into new bonds. This keeps the liquidity trapped in the U.S. system. It keeps the Ponzi scheme going. But starting this morning, they stopped rolling over. When a $10 billion tranche of debt matured, the Saudis took the cash and walked away. They did not buy the new debt issuance. Even worse, sources indicate they are actively selling their longer-dated 10-year and 30-year treasuries on the secondary market. Why is this a financial nuclear weapon? Because the U.S. government is currently drowning in $36 trillion of national debt. To keep the lights on, the Treasury Department needs to issue billions of dollars in new debt every single week. They rely on whales like Saudi Arabia, China, and Japan to show up at the auction and buy that paper. If the whales stop buying, who fills the void? There is no one left. China has been selling for years. Japan is selling to prop up their collapsing yen. And now the Saudis, the lender of last resort, are selling to protect themselves from the Venezuela precedent. This creates a liquidity vacuum. In a healthy market, for every seller, there is a buyer. But right now, there are more sellers of U.S. debt than buyers. When that happens, basic economics takes over, the price of the bonds crashes. And when bond prices crash, yields, interest rates spike. This is the nightmare scenario for the Federal Reserve. We are already seeing the 10-year Treasury yield creeping up dangerously high in after-hours trading. If it breaks above 5% or 6%, it acts like a wrecking ball to the entire U.S. economy. Mortgage rates will skyrocket to 10% or 12%, instantly freezing the housing market. Auto loans will default. Regional banks, which are holding massive amounts of these crashing bonds as collateral, will face immediate insolvency. We are talking about a banking crisis that makes 2008 look like a picnic, but the Saudis know exactly what they are doing.